Welcome to Pacific Financial Planners educational series. Today we're here to talk about risk management. When it comes to investments, a lot of people think it really matters what you buy. Very important. That's called asset management. But in addition to asset management comes risk management. How to manage the risk on the things you decide to buy. Because it's when you sell that counts. That's where the money is made. I remember meeting in the late 90s some clients they were new prospects that had some stocks that they bought around $25 a share. It was EMC of all things, and it appreciated to over $100 a share. And then what happened is I met them and I said, you know, the thing's starting to drop. Let's put a stop loss and sell it if it gets below 90. And they said, geez, Jerry, we'd have a huge capital gain and we'd have all these taxes. And they decided not to go with me and not to go with any risk management plan. And then what happened is the stock in the early 2000s dropped to under $10 a share. And I called them up and said, well, geez, how do you feel now? You can sell it and you can get a tax write-off as opposed to paying tax gains. So it's very important that you use a risk management plan on everything you ever purchase. And that's what we're talking about, is stop losses. Anytime you buy anything, it's important to decide in advance how much money you're willing to lose in case things don't work out. Very important decision. Not only should I buy it, but if it, we always buy things because we want it to go up in value. But what if it doesn't work? What if it goes down in value? You need to have a plan, an exit strategy. Not doing the same thing, banging your head against the wall. An exit strategy that clearly defines how much money you're willing to lose. So there's 4 ways to set a stop loss. A lot of people just use a percentage method, like the IBD, Investors Business Daily, says 8%. It's fairly random. You can look at moving averages, you can look at trend lines, and you can look at support resistance lines. Trend lines are the lines that go up when you connect the bottoms. Support resistance are previous highs that become a floor once they break through. So very important that you have some sort of strategy. To the degree that you can envelop all 4 of those, to where it's within 10% of your buy point, it's above a trend line going up, above a support resistance, above a significant moving average, and within a certain percentage of where you bought it from, that's when you know you've got a good entry point and a good risk management plan in place. We can help you here at Pacific Financial Planners. My name is Jerry Slusowitz. Sign up for our free, no obligation newsletter. All we really need is your email address. We ask a bunch of other questions here on this free sign up for our newsletter, but just at least give us your email. If you would like to have that free portfolio review, answer the other questions, we'd be glad to get a hold of you, set an appointment, review your portfolio, and put a risk management plan to place for you. Remember, it's not what you make, but rather what you keep that counts. Have a great time investing.